Closing out a really tough month of February. Live from New York City this morning. Good morning, good morning. Equity futures trying to bounce by about 1/10%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Live from New York coming up. Bond slide as European inflation accelerates. Goldman's Investor Day kicking off in New York. And Target delivering a cautious forecast. We begin with a big issue, the American consumer.
This debate around whether or not the consumer is healthy.
The consumer is extremely strong.
Strong.
Resilient.
There's just so much data that has come out.
That healthy consumer spending number.
That tells us that the consumer is very strong.
The state of the consumer right now looks pretty good.
Feels pretty good.
The consumer in the U.S. is still in a good place.
You have this really golden environment.
The labor market is just remarkably resilient.
Incredibly resilient.
The consumer will increasingly have more discretionary income.
Consumers will have the ability to keep the economy going.
The question really becomes, how long is that going to continue?
We need to keep things in context.
At some point later this year, you'll start to see the consumer crack.
Target offering another look on that story. Here's Bloomberg's Kaylee Lyons. Hey, Kaylee.
Yeah, well, the backward look, at least, John, is pretty healthy. The consumer clearly hasn't cracked yet because Target actually blew it out of the water on earnings per share, $1.89. The street was only looking for $1.48, and comp sales actually were up about 0.7%, whereas analysts thought they would fall 1.7%. So backwards look, thumbs up. Forward look, however, is a bit of a different story. Target saying at the maximum they expect to make $8.75 a share this year. That is about 50 cents below what the street was looking for, and that is due to just a lot of macroeconomic uncertainty, a lack of clarity around what is going to happen to consumers' discretionary spending. This is a very similar story to what we heard from Walmart last week. That said, when you look at the notes coming from the sell side this morning, they don't seem to be too concerned. Some of the words they used in those notes this morning include an unsurprising forecast, conservative, better than feared. And another reason the street is finding for optimism is the progress on working down inventories. Remember, during the pandemic era, Target did not have enough stuff and too much demand. That quickly turned into a story of too much stuff that people no longer wanted. Demand went down, and we saw massive builds in inventory, between 30 and 43% in several quarter periods starting a year ago. But finally, Target making progress. Inventory is actually falling 2.9% in this period. So that is a very important part of the story. It is leading to improving sentiment in the stock, which is not the chart we are looking at here. I believe that is a chart about inflation. But if you take a look at Target's performance on a year-to-date basis, not only is it up about 11% after its worst year since the year 2000 last year, a 36% decline, it is also outpacing Walmart. That said, this morning, though, John, the stock down about 0.4% in pre-market trading. So
right now, at
not
least,
a massive move.
But that stock so far this morning, all over the place. Kaylee Lyons, thank you. I think it was down 4-5%, then up around about 5%. Got some breaking news just moments ago. Want to cross over to Abby to pick up on that. Hey, Abby.
Hey, John. Well, we do indeed have breaking news on Tesla, and they have announced that they are going to be building a plant in Monterrey, Mexico. This, according to Andres Manuel Lopez Obrador, AMLO, the president of Mexico and the United Mexican States. The stock is holding its gains. It's up about 1.6%. And I think an important takeaway here, John, could be, of course, because they've been discounting recently, there's been some concern about demand. But the fact that they're now going to be bringing more supply online in Mexico would suggest that maybe it's somewhat healthy. Again, the actual headline is that Tesla will be building a plant in Monterrey, Mexico.
That stock is up by about 1.6% in the pre-market. Futures positive by about 0.1%. Let's talk about this consumer in America with Crossmark's Victoria Fernandez, Morgan Stanley's Andrew Slimmon. To the both of you, thanks for being with us. Victoria, first to you. Something you said. You said you can think this economy looks great, but I don't believe it. Why is that?
I mean, Jonathan, we look at all of these things that people say, you know, look, the economy is strong, the labor market is strong, earnings maybe weren't as bad as people expected, PMIs are doing well, wages are up, and that's all true. And I can see how that's supportive of the economy. But look, you know, I manage fixed income too. So I have that risk averse side of me that says, wait a minute, Leading economic indicators are down 10 months in a row. We have earnings expectations continuing to come down at a pace actually over the last quarter that is the highest it's been in the last 25 years without being in a recession. We still have the lagged effects of 450 basis points of rate hikes coming in, the inflation story that we can talk about with the labor market as well. And we've talked about M2 money growth falling. So those are the items that say, all right, hold on, hold your horses here. I don't think we're in a sustainable bull rally. I think the consumer does have some strength on their balance sheet because of the stimulus payments, that they're still there. I think we have about $1 trillion left of that. And because wages continue to be strong, because outside of the tech sector, you're seeing labor hoarding going on. And so I think because of all that, we've got maybe a mild recession coming, but not a deep recession. And that's all because of the strength of the consumer. I just don't think we can say it's an all clear from here.
I want to share some work from Ellen Zentner of Morgan Stanley, but I want to keep Andrew out of trouble. So I won't ask Andrew to comment on this. I'll ask Victoria. So Andrew, just be patient if you can. This from Ellen Zentner just moments ago. In the last 24 hours, she said labour market catch-up, excess savings, lower energy prices, they're boosting the consumer, but a slowdown is still coming. We see the first cut delayed to March 24, followed by more gradual easing. So pushing out this rate cut call. Victoria, given what you've just said, does that stack up?
It does. I mean, Jonathan, we talked, a few weeks ago, and I said I can't believe that the market is actually pricing in rate cuts for 2023. I actually think we're going to see rate hikes continue probably into the June meeting, maybe even later into the year, depending on if consumer demand continues to be as high as it is. You look at that labor market right now, construction jobs, there's over 400,000 openings for that. You look at manufacturing, almost 800,000 openings in manufacturing. They're going to have to see wages continue to go higher because we don't have the migrant population that used to fill these roles here right now. There's a structural change in the labor market, and that's going to cause wages to go higher. It's going to make inflation stickier, and all of that, even though it's positive for a consumer, that tells the Fed their job is nowhere near done. And we're seeing 2-year yields across the board, not just in the U.S., but you look at Canada, Mexico, Singapore, India, around the globe at cycle highs. I think that tells us we still have a ways to go and no cuts until 2024.
Look at Europe this morning as well. If you want to look at the Treasury market, 481 on a 2-year, up 3 basis points on a session. Andrew, credit where it's due. You came into 2023, you said there was upside risk to the equity market. That's materialized. I guess the question for you now, sir, given the sell-off this month, what now?
Well, I think the setup into March is much better than it was into February, which is, after a roaring January, sentiment got a lot more optimistic. The relative strength index got very overbought, and we were set up for a bad February. And now that, we've had a bad February, inflation higher and so forth, I think the setup is better into March. And, something that I would say about the consumer is, look, I'm an equity manager, and what I care about is expectations. And if you look at Target today, last year, if they reported this number, I think the stock would have been down a ton. But it was down 36% last year, as Kayleigh said. And therefore, it's been de-risked. And the fact of the matter is their earnings, right, their earnings estimates got absolutely crushed last year. So the rate of change in their estimate cuts is actually slowing. So this is the key point I think people are missing, which is it's the second derivative of earnings revisions. And for many companies, not all, probably not for the mega cap tech stocks, for many companies, the rate of revision, negative revisions, is actually slowing. And that's why the stock is not down, even though it wasn't, they lowered guidance for the future.
So things aren't just getting as bad as quickly as they were before. Andrew, still sounds pretty bad, but ultimately I get it, that it's about change for equities. So where's that theme more pronounced?
Well, I think you want to search for companies that that were crushed last year, that estimates have already been de-risked. And I think this is a perfect example. Many consumer stocks have been de-risked, not the market overall. The mega cap tech stocks, if you look at earnings revisions year to date, roughly half the negative revisions have come from 6 mega cap tech stocks plus a few energy stocks. I would be careful on those names simply because they didn't de-risk last year. Many of the consumer discretionary stocks de-risked last year. They were absolutely hammered. And to me, that's where you that's where you find your best opportunity. So I think inflation is going to remain sticky, but we're going to really find out how sticky to the second half of the year. I still think the first half of this year sets up pretty good for equities, and then we're going to find out more about the economy, about inflation in the second half.
Well, Andrew, to your point, discretionary year to date on the S&P 500 up 12%. Worldwide, the airlines absolutely flying. Forgive the pun. In Europe too, I've got Lufthansa up 26% from the close yesterday, not including what's happened today. Air France up by more than 40% year to date. Victoria, where are you on some of the discretionary names at the moment?
Yeah, so I think you do have to have some exposure to these discretionary names. We were at a conference last week with a lot of our clients, and the question was, how do we position our portfolio? Well, you need to have some exposure to some of those staple names. We like some of the healthcare, some of the HMO names, but you need to have some exposure to the cyclicality in the market as well, because I think it is going to be a churning market from here till the end of the year. I don't mean to be a Debbie Downer, but I mean, I don't see the market doing too much from where we currently sit for the next 9 months. So that tells us you have to be opportunistic and tactical. Look at some of those cyclical names. When they're up, trim them. When they're down, as Andrew was saying, then you can go in and buy some of those names. It's where the quantitative component of your model comes into play, not just the fundamental side. Look at the trends, look at those that have sustained themselves above their 200-day moving average and go into them. Some of those cyclical names, some of those discretionary names that works with. Credit cards. We like American Express. We added a little bit to American Express this week because, again, the strength of the consumer. So there's some opportunities there. I think you just have to be very cautious and be choosy.
Luxury in Europe, Hermes, Kering, LVMH, all up anywhere between 17 and 18% from the close yesterday, year to date. I look at the airlines here in the United States, Andrew. American year to date, 23% higher. United, 35% higher. Delta, 15% higher. Are there reasons, Andrew, then to stick with some of those names?
Well, I mean, first of all, yeah, consumer discretion is up 12%, but it was down 37% last year, Jonathan. So let's keep that in mind. First of all, number two is, keep in mind the University of Michigan consumer sentiment hit an all-time low, 45-year low last year. So the rate, again, the second derivative, it is about that things are going to improve. The sentiment is improving. So I wouldn't necessarily buy the strongest ones. I would look for areas that have been hit, like the home furnishing. They were crushed last year. Home apparel. I understand they've had bounces this year, but to me, that's a very intriguing area because I think things are getting worse.
Let's throw some research into the mix. Mike Gapon, Bank of America. This is what he had to say yesterday. He said a big slowdown in consumer demand might be needed for inflation to return to 2%. This could require several more Fed hikes. So, Victoria, let me ask you this. If you're long consumer discretionary, are you fighting the Fed?
No, and Jonathan, I have said all along the market was fighting the Fed, and I couldn't understand why they were doing that. And we're not saying go 100% into consumer discretionary. We're saying have some exposure because there's going to be a lot of volatility in this market, and you want to be able to have some balance in your portfolio and take advantage of that. But I don't think you fight the Fed here. They have told you over and over again they're going to be higher for longer. Look at what the Fed funds futures have done over the last few weeks. They've gone up, 50, 60 basis points. I think it's around a 535 now. We still have a ways to go. So I don't think you want to fight that, but I think you can be opportunistic. Add a little bit of fixed income in there. Look at those short-term yields. If you see some opportunity on the long end of the curve, lock some of that in too, because we're probably getting closer to the top on the long end of the curve because of what inflation expectations are doing. So I think you have to tie all that together. Don't go long all in one area. You have to be choosy. And look, Target said today, inventories on discretionary are down 13%. That was the issue they had last quarter. So the consumers are out there. They are buying. You just have to be cautious.
Futures just about unchanged on the S&P. Victoria, Andrew are going to be sticking with us. Let's get you some movements. We can do that with Abby. Morning, Abby.
Morning, John. Well, if we take a look at the shares of Chevron, we are going to see that they are popping. Yes, oil is higher on the morning, but we also have Chevron announcing that they're boosting their buyback program by about 17%, from $15 billion to about $17.5 billion. It could go as high as $20 billion, really trying to create shareholder value. So those shares, again, popping, really almost soaring, moderate soar, I guess I would say. say Zoom up 4.3%. Out of the doldrums for at least now. The stock, of course, from its peak down more than 87%. But in the most recent quarter, it was OK. They also boosted the profit forecast to 96 cents to 98 cents, about 13% better. Large customer solid. So right now, a little bit of life for Zoom. And then finally, Norwegian Cruise Line, not so much, down 6.4%. The fourth quarter loss was wider. The forecast is a bit disappointing. What's interesting is bookings are solid, revenue solid, John, but it seems as though they're not managing the cost so well.
We don't cruise on this show, as you know, Abby. Thank you for that. That's the latest on some of those names. Coming up, Eurozone inflation surprising to the upside.
Inflation is returning, and this must be of biggest concern for the central banks. So in order to avoid that, we must move much more towards targeted intervention, targeted support.
That conversation up next.
Inflation is returning, and this must be of biggest concern for the central banks. So in order to avoid that, we must move much more towards targeted intervention, targeted support, and not the big water hose splashing water everywhere. That will only fuel inflation, and that is the worst thing that can happen.
Inflation surprising to the upside in Europe. Spanish CPI unexpectedly accelerating. France delivering a record high print this month, sending bond yields across the Eurozone higher, with investors briefly pricing in a 4% ECB terminal rate. Mike McKee, Mike, do you remember not even a month ago when Chairman Powell said the disinflationary process has started, then a day later President Lagarde turned around and she said the risks around inflation are becoming more balanced? That feels like a lifetime ago.
Well, it was only this morning, John, that Philip Lane, the ECB chief economist, went out on that same limb. This is what you don't want to be saying when you get surprise inflation numbers. There's significant evidence that monetary policy is kicking in, Mr. Lane told Reuters today. And then a couple hours later, we got inflation reports from France and Spain that shocked to the upside. France, supposed to be unchanged, goes to 7.2% from 7%, and the Spanish inflation number 6.2% from 6%. And on top of that, both of them setting records for Eurozone era participation for their headline and core rates. They're at new high levels. And because of that, we're seeing quite the reaction in European markets. Break-evens have gone to new highs for the year, and for even longer than that. We're seeing rates rise significantly across the Eurozone, and even in the UK, 10-year break-evens at a 2-month high, and that's a reaction to what's going on in Europe. We are seeing the reaction in U.S. bonds here as well, and as you mentioned, the ECB benchmark rate trade has really gone up. You can see where we are now, and you can see where the terminal rate is now forecast by the markets, just under 4%. So at this point, all bets are off. And the interesting question that was brought up this morning is, if the ECB is going this high and the Fed is going as high as we think it's going to go, then we're going to have a really synchronous tightening of credit around the world that may feed back on itself.
Just surprising, Mike, to see the numbers at these levels in Europe. Just remarkable. Mike McKee, thank you. I think that question Mike asked is really, really important. Victoria Fernandez, we're going to have more hiking at the ECB, more hiking at the Federal Reserve. I want to go back to the Fed earlier this month. Feb 1, February 1st, on a Wednesday, Chairman Powell, disinflationary process has started. The 2nd, on a Thursday, President Lagarde turns around and says the risks around the inflation outlook are more balanced. What on earth happened?
Well, I think people were looking at just certain elements of inflation. They were looking at goods producing sectors, which we've seen disinflation there. And we knew that that was going to happen as supply chains improved across the globe. I think when you look at Europe, there's some expectation that because the energy crisis was not as bad as what people expected, that you would see some disinflation coming in that area. And what's happened is that there's other elements that are feeding through that are keeping levels higher. Services inflation in the U.S., I understand people think rent inflation is, elevated and it's higher than it should be, and that's going to come down. But let's look at other elements. We talked about the labor market. We talked about labor hoarding that we have there. I think we've got a debt ceiling debate coming at us that's going to cause some more issuance. We've got stimulus packages around the globe that are going to be causing some issues. You've got China opening up. So there's all sorts of underlying elements, kind of undercurrents that are feeding that inflation component on the services side. And people have been so focused on the goods side. We also have to look at, are they going to stick with a 2% inflation target, Jonathan? I think this is a key issue people have to look at. The central banks say, yes, we're doing that. I'm not so sure. I think they get around 3%, and they're going to say maybe that's good enough because they don't want to push the global economy into a deep recession. We'll have to see.
You're not the first person who's asked that question. I imagine a lot more people will do the same thing. Andrew, the ECB, we are pricing maybe a 4% peak rate. I've got no idea if that's going to be achieved. We're talking 550 potentially at the Federal Reserve. In reality, I can get 5% right now on a 6-month T-bill. Andrew, how much of a challenge is that to your equity market?
It's a big challenge. It's a big challenge. I hear all the time from advisors, why should I take the risk of equities when I can get, 4 or 5% risk-free? And that's the issue for stocks. The problem with that is, if you lock in a year from now and rates do eventually come down, I think Victoria's dead on right, which is I think we're going to 3%. We're not going to 2%. Then equities will be higher and you won't get the same yield. And that's, it's kind of classic, Jonathan, early cycle, which is, in the 90s, I was a financial advisor and clients would come see us and say, I'm not greedy. I just want 10 to 15% returns without a lot of risk. And now people are saying, I'll take 4% risk-free. It's a sign of, what Warren Buffett says, people drive and looking in the rearview mirror. If you can get 4% risk-free and last year you lost money, you take the 4%. But if last year with the market's up 20%, you don't take the 4%. Yeah. So I think it's just a sign of where we are in the cycle, which is very early. There's a lot of uncertainty, but uncertainty creates opportunities, as Victoria said, not across the board, but selectively.
Well, again, it's either very early in the cycle or very, very late in the cycle. Andrew Sliman, Victoria Fernandez, to the both of you, thank you, as always. In the bond market, these moves in bunds, up 13 basis points on a 2-year in Germany. We're pushing 320. Coming up, the morning calls, and later, Hightower's Patrick Rossetti seeing opportunities in energy. Equities turning just a little bit lower going into the opening bound. Let's get you some morning calls. First up, Bank of America downgrading Dish Networks to underperform, pointing to higher marketing expenses and adverse pay TV trends. Next up, Susquehanna downgrading lending tree to neutral, seeing limited upside with macro headwinds piling up. Their stock negative 0.8. And finally, Citi downgrading Dick's Sporting Goods to neutral, expecting crowded inventories to continue weighing on gross margins. Coming up, Target topping earnings estimates but delivering a cautious outlook. We'll talk that next with Patrick Rossetti of Hightower. Closing out the month of February, and we were looking for a day of gains, and that fades. Going into the opening bout, futures negative 0.1% on the S&P and the Nasdaq, down 0.2%, and heading towards a monthly loss for the S&P 500 and for the Nasdaq too. There's your opening bout. Switch at the board and get to the bond market. Month to date, yields much higher. Off the lows of the year, off the lows of the month, we are higher on a 10-year, on a 2-year. On a 2-year by something like 80 basis points, in and around. On a 10-year right now at 4 or 5 basis points on a session, 396.30. On euro dollar, higher the month, 110.33. That was the same day as the ECB. Lower the month, 105.33. Right at now, 106.24. Positive 0.1%. Euro just a little bit stronger. Next stop here is CPI day out of the Eurozone in a couple of days, and a read on German inflation, which comes tomorrow. Get this nice, lovely regional breakdown, and you can figure it out for yourself. You'll get that tomorrow. Looking at crude at the moment, 77.40 on WTI, up by 2.3%. And amazing to see inflation expectations start to build again without a rally in crude, unlike what we've seen over the last couple of years. At the open then, about 45 seconds in, your equity market looks a little something like this. The S&P down 0.1%, the Nasdaq down about 0.1% also. One stock to watch, Target, all over the place this morning. The retailer topping earnings estimates but delivering a tepid outlook. The CEO said this: "We're planning our business cautiously in the near term to ensure we remain agile and responsive to the current operating environment." Abby has more. Hey, Abby.
Hey, John. Well, this is interesting, the trading action on the morning, because earlier, of course, it had been lower, now slightly higher. And we do have CEO Brian Cornell presenting here in New York, and he just made comments saying that the coming years will be more like pre-pandemic era. In addition, there are comments from the chief growth officer, Christina Hennington, saying that they're going to expanding more than 10 private label brands. So that's probably offsetting some of the weakness. I really like the way that Kelly Lyons put it earlier, saying that in the past, thumbs up, to the future, though, thumbs down. But it seems like a little bit of a mix here. So they really beat in a big way on both the top and bottom lines. But you can see here that what folks are concerned about for the fourth quarter, their comp sales did raise 0.7%. For the fourth quarter, though, they estimate down. As for the inventories, for the first time in a year, this is another bright spot. They are actually trending in the right direction. They are down. So perhaps, again, this is perhaps some of the piece of why investors are cheering the stock higher, despite the challenging environment and the pullback in discretionary spending that they're saying. This company, of course, their store somewhere between nice to have and need to have. Discretionary up 12% on the year. That, of course, is also Tesla and some of the travel stocks. But into today, and now with the gain, we have Target up about 12% on the year. Staples, not so much. So it's an interesting morning that we're seeing here as investors reconsider the strength that they had and thinking that maybe some of it will, maybe that the idea that they're a little bit conservative with that outlook, John.
Abby, thank you. Goldman weighed in on some of this. Here's the quote from Goldman Sachs and a team this morning. They said, hard to decide how to treat this. A very mixed bag. Comp sales are still intact, and they guided sales as expected. The issue is gross margins, missed by about double what most expected, and they did guide a bit worse. The stock just about positive in the early part of trading. We'll keep an eye on that. Target up by about 1%. Sticking with earnings, Zoom Video crushing Q4 estimates, delivering an upbeat forecast. The stock's flying. Cost-cutting measures helping offset a slowdown in sales. The CEO saying this: while the macroeconomic situation continues to negatively impact our overall growth, Zoom is dedicated to maintaining a careful balance between growth and profitability. On that story, Isabel Lee. Hey, Isabel.
Hi, John. That's exactly right. So if you think Zoom and other pandemic darlings, if their days are numbered, you might want to think again, because Zoom shares are rallying today. It's on track for its biggest gain in 3 weeks. That's after the company reported fourth quarter results that beat estimates, and also outlook for adjusted earnings that were much stronger than expected. Zoom expects earnings to fall around 96 to 98 cents, and that's higher than the 87-cent estimate. So what's driving this? Well, you know, we've seen a slowdown in sales, but the company did employ aggressive cost-cutting measures. So recall that earlier this year, they slashed around 15% of their workforce. That's more aggressive than some of its tech peers. But it seems to be paying off, because analysts were very positive about the company's earnings. margins rather, and did note that its online business was continuing to decline. So that's not really a surprise because people have been doing much less, with the return to work policies. We have been doing much less. Zoom said many of its customers' defections have come from casual users, so this includes small businesses. So it remains to be seen what becomes of Zoom. Zoom is now touting products related to artificial intelligence, but if anything, the fourth quarter showed that Zoom is back on its footing. The stock soared in 2020, but lost most of its value in the next 2 years. So it remains to be seen what will happen to Zoom this year. It's become an adjective after all, with people saying we're zooming. John.
Down more than 80% from the highs of 2020. Incredible turnaround. Isabel Lee, thank you. The stock's up just marginally in the early part of this session, 4 minutes into this session. One more stock to have a look at. Shares of Norwegian Cruise under pressure, posting a wider than expected quarterly loss. The company saying, quote, we're undertaking a broad and ongoing margin enhancement initiative. There's some real C-suite speak for you, in hopes of trimming costs this year. Katie, what do you make of that line? Undertaking a broad and ongoing margin enhancement initiative.
Margin enhancement. It seems like margins are the focus of this earnings season. And let's get specific on some of those numbers. You had fourth quarter adjusted loss per share. It came in at about $1.04. Analysts had been looking for a loss of about 87 cents. Then you look at adjusted EBITDA. The loss there was about $41 million. Estimates for $8.6 million. So a lot of daylight between those two numbers. You add that together, shares are down about 6% right now. And net income was also in the red. And unfortunately for Norwegian, that's a trend. It hasn't posted a profit since the start of the pandemic. Now, Bloomberg Intelligence points out that bookings, occupancy, they are solid, but cost-cutting efforts, they need focus. That campaign is underway. We're going to see if that actually does enhance their margins. But this comes after more than a 55% plunge for Norwegian over the past 3 years. If you stack that up against other travel stocks, you can see that Carnival is down, 60% in that time frame. Airlines down about 19%, not too bad. Your relative outperformer is actually Royal Caribbean. It did bounce back more quickly than some of those peers, and that does include Norwegian, John.
That 3-year story that you just painted, that looks brutal. Katie Grifo, Katie, thank you. The broader story right now, about 6 minutes in, no real drama. We're down about 0.25% on the S&P. The underperformance coming from utilities, coming from consumer staples. The outperformance, just relatively speaking, just about positive on the session. Energy. We're going to talk about that right now with Patrick Frazzetti of Rose Advisors at Hightower. He joins us right now. Patrick, great to catch up as always, buddy. I know you like this sector, you like energy. Tell us why.
Yeah, sure. Look, I mean, when you look across the sector, higher cost of capital for marginal producers, China's reopening its economy, which is probably one of the biggest factors. And, there's still significant inelasticity of demand by, poor nations around the world, emerging market countries. So, we still look to energy markets in an inflationary environment to be very well supported.
Patrick, it's amazing that we started the year talking about China reopening and crude's barely moved. It's pretty much dead flat on the year so far. Do you need crude to rally to make that energy equity story work?
Eventually you do. I just think there's been nothing to really change the supply side of the equation, right? I mean, the regulatory environment is still pretty stringent, but demand has been pretty consistent, and I see that improving throughout the year. So I think eventually you'll see the price reflect that. Look, there's been a lot of economic noise in the data. So I think that's probably part of the reason. You've seen, a shift in sort of the weakening of the dollar and then the strengthening of the dollar. And then you see inflation numbers come out in Europe today. So maybe another slight weakening in the dollar. So there's been a lot of fluctuation to start the year.
Well, the capital returns look good. Chevron stands out this morning, that's for sure, Patrick. Chevron coming out and saying we're going to have a rate of buybacks of $17.5 billion annually beginning in the second quarter. Previously planned $15 billion. Are you expecting that across the United States? Some of these big energy players, do you expect it from the European names too?
Yeah, I definitely think so. It's about capital discipline. Returning, money to shareholders, is certainly one aspect of that. So whether it's buying back stock, special dividends, we've seen that in some of the parts of the sector as well. So I think it's just an attractive area to have some exposure to. in this type of environment. And it doesn't take much to really be overweight the sector. I mean, it's still a measly, 4 or 5% of the total market. So I think to have some exposure makes some sense in this environment for sure.
Patrick, when things get tough, people say things like, we need to get defensive. We need to get defensive. Yeah. And defensive can mean a bunch of things. It often just means whatever works when things are tough. And last year, energy was defensive because that worked when things were tough. Energy was up 59% on the year in that group. What's defensive in 2023?
Sure. So I think the term defensive means, what could potentially work in the environment we're in. And knowing that, if you're wrong, you're not going to drastically outperform. And so when I think about defensive, other than energy, I think precious metals will do well. I think a lot of consumer businesses, there's a lot to be said. I know you talked about staples a little bit earlier. I think while maybe household products underperform in an inflationary environment, I think things like beverages and areas in the food industry could work very well. And then obviously in the consumer side of the energy equation.
Is that discretionary services in the mix as well for you?
Yeah, absolutely. Absolutely. Because, that's one area where you can pass along inflation pretty easily, is in the services sector. So, we're beginning to see, across the board, particularly in the stocks we're looking at, look, there's always stocks to find in any environment. I think, Peter Lynch coined the term, far more money has been lost in the corrections themselves, lost by investors to anticipate corrections than in the corrections themselves. So I think just you have to be active in this environment and trying to find the right companies and diversifying your portfolio appropriately.
Well, let's talk about diversification then. How do you diversify in a world where bonds and stocks fall together?
It depends where you are on the spectrum, right? So when you look at stocks, there are certain stocks that underperformed dramatically last year. You just look at some of the speculative excesses, particularly in tech. But then there are sectors like energy, consumer, healthcare that did very well last year. And in bonds, it's about duration and credit risk. So where are you on the spectrum? So you can be further out on the credit spectrum. I wouldn't be playing in sort of the non-investment grade market today. I would stay in high quality names, and I am staying sort of short to intermediate duration. So I think that's what you need to do to protect capital this year.
Patrick, appreciate your take on the market as always. Patrick Frazetti there of Hightower. Looking at the oil market right now, about 11 minutes into the session, equities are just about a negative by not even 0.1%. The Nasdaq just about positive. The story of the morning, though, it came out of Europe. Upside surprise in France, in Spain. On the inflation side of things, you'll get a read from Germany tomorrow, then the overall Eurozone a day later. But for the bond market in the United States, it means yields are higher by 5 basis points at the front end. 482 on a 10-year, up 6 basis points. Very, very close to 4% again on a 10-year maturity. Let's call it 398 right now and round this one up. And take a look at what's happening in Germany, because in Germany, we've gone from talking about negative rates 12 months ago. I think the 10-year, or the 2-year rather, was negative about 70 basis points. At the front end of the curve in Germany right now, we're higher by 11 or 12 basis points to 3.16%. And we're pricing in potentially the ECB peaking at this rate hiking cycle at something close to 4. These were numbers that were totally unthinkable 12 months ago, and now we're having a real conversation about them. We'll pick up on that story a little bit later on throughout the day, and of course tomorrow as well. We'll get another breakdown of German CPI. Coming up, Goldman CEO David Solomon taking center stage in New York.
There were some clear successes, but there were also some clear stumbles. On the direct consumer businesses, we found them more challenging.
We're on Goldman's Investor Day, up next.
There were some clear successes, but there were also some clear stumbles. On the direct consumer businesses, we found them more challenging. It became clear that we lacked certain competitive advantage and that we did too much too quickly, which affected our execution.
Goldman Sachs and Chevron both kicking off their investor days this morning. Goldman leaders hoping to rally investors around the stock after profits slumped by half last year. This as Chevron is raising its share buyback rate despite falling oil prices. Your team coverage starts right now with Bloomberg's Shanali Basak and Anne-Marie Hordern. Let's start with you, Shanali. Just how big, how great is the pressure on the shoulders of that man?
Of course, there's a lot of pressure on Goldman Sachs at this point in time as the environment gets tough out there, John. But I want to point out a few numbers here because there's some really big proclamations being made here at the Goldman Investor Day. One being that they could cut another $1 billion in costs. We're going to see where those costs can potentially come from. Remember, Goldman Sachs already had a big wave of job cuts. But then the other here is this idea of considering strategic alternatives for that consumer business. So you heard David Solomon himself just say, you know, there were some real wins here, but there were also some stumbles. The question here is they've given you a 2-year track to get to profitability for this consumer business. Do they end up doing something different before that? Strategic alternatives typically means a sale or other alternatives for a business like that.
A different story, AMH, for Chevron. Should we talk DC buybacks and lead balloons?
Yeah, seriously, it is. This is going to be something that's going to certainly get a response at some point, Jonathan, right from the White House. What you've seen over the course of the past year is that this administration has lambasted the oil industry for what they say, and the president said this as recently as February 7th on his State of the Union, these excessive, outrageous, what he says, returns, and instead of putting them into the ground and pumping more, what he says, to bring down gasoline prices, they are giving them back to shareholders. At the same time, Jonathan, it's an awkward line, right, for the administration to walk. They're asking the oil industry to pump more. At the same time, this administration, they came in, they wanted to, President Biden wanted to be a climate president, and he's trying to get rid of the product in the long run that at the moment he's asking for more of.
When you do those news conferences with whoever it is from the administration, do you think someone might read that quote from Warren Buffett from over the weekend, Anne-Marie? This quote here, when you're told that all repurchases are harmful to shareholders or to the country or particularly beneficial to CEOs, you are listening to either an economic illiterate or a silver-tongued demagogue. Is that something that might come up in Washington later?
It might certainly will, Jonathan. And without naming names, you can tell potentially where Mr. Buffett was pointing his finger at when he's talking about that. In the same State of the Union speech, the president reiterated something he's been calling for, which is quadrupling the tax on share buybacks across the board. So obviously the oil industry took a hit, but then he was leaning at corporations writ large that these share buybacks should have a higher tax. And this is something he continuously calls for.
That debate's not fading away, dying out anytime soon. Anne-Marie Hordern down in DC. Shanali, looking forward to your conversation later. Just a programming note so you all don't miss it. Shanali interviewing with Goldman Sachs' president and COO, John Waldron, a conversation between the two at 12 p.m. Eastern time, so about 2 hours and 10 minutes from now. Look out for that a little bit later. So the focus today on an investor day for Goldman, for Chevron. Tomorrow, it's Tesla's turn. This coming as the stock has more than doubled from its January 6th low, pushing Tesla closer to becoming the 5th most valuable US company all over again. David Welsh has more on this. David, what are you looking out for? What should we be looking out for tomorrow?
What's the continued growth story here? Clearly, the shares are on the rise in anticipation, at least in part, to what he's going to say tomorrow with the Master Plan 3. We could see the Tesla Model 2, which is the 25,000 or thereabouts inexpensive Tesla. That could give the company a lot of growth in an area where right now they're just not playing. Really, nobody is, except for maybe General Motors and to a smaller degree Nissan. So we could get detail on that. Maybe he confirms that the Cybertruck will actually go into production at the end of the year and talk about how much growth we'll get there for the company. That's sort of one of the, let's say, several things that had stalled the shares out until this recent rise. Was investors are wondering, is the bloom off the rose? Is all the competition from the legacy automakers starting to eat into Tesla's growth? And if you've got a new small car, if you've got Cybertruck and some volume there, that could all help. I think he will talk about supply chain and how they're going to secure battery minerals and metals. Maybe they're going to start investing in mines and companies the way General Motors has. And then, look, you've got news this morning that Tesla's going to build a plant in Mexico. I don't think it's for the Mexican market. Mexico has 40 or 50 free trade agreements with countries around the globe. So that could be a big export hub for Tesla to open new markets with some cheaply made vehicles. Yeah, you look at all the auto plants down in Mexico. That's a huge export hub because you can get parts in tariff-free and you can send vehicles out tariff-free and you make them with cheap labor. So there could be an export story from Tesla coming out of this.
Hey, David, we'll catch up tomorrow, no doubt, on the Investor Day. David Welsh there on the latest here at Bloomberg. Broader equity market down about 0.1% on the S&P, pretty much unchanged, dead flat on the Nasdaq. Got some breaking news, economic news just moments ago. Mike McKee has that for you. Morning, Mike.
Morning, John. We'll make this quick because it's not particularly good news. Chicago PMI comes in at 43.6. That's down from 44.3 last month, and it was expected to rise. So it raises questions along with some of the other regional PMIs that we have seen about what ISM will show, which is out tomorrow, 10 a.m. Wall Street time. It's expected to rise to 48 from 47.4. Now, the ISM manufacturing index has remained below 50. Services have crossed above. We get services later in the week, so a lot of attention will be paid to those.
Mike McKee, more data still to come. We'll avoid that one for now because that one was unexpected, I guess. Comes in below expectations, 43.6. The estimate, 45.5. As Mike's pointed out all week, the ISM a little bit later this week, that is the one to watch. We'll pick up on that a little bit later in the week. We've got some time for some sector price action. We can do that, as always, with Abby. Hey, Abby.
Hey, John. Well, we have another low-volume day today. At this point, we have the S&P 500 down slightly. Not surprisingly, we have the sectors relatively mixed. No sector moving more than 1%. Most interesting, the sectors on the bottom, healthcare, staples, utilities down the most. That has to do with the fact that they have high dividends. Yields are higher today, so those stocks look less attractive. As for Norwegian Cruise Line, of course, it's down on the day on the outlook, but on the year, these travel gains that we've been talking about, John, it's really out of control. Hotels, the leisure sector, and then, of course, the media index, all in 2 months up really sharply.
Abby, thanks for that. That's the breakdown of the sector price action. Up next, your trading diary. Around about 25 minutes into the session, equities totally unchanged on the S&P 500. Similar story in the Nasdaq as well. On the session, at least on the months, we are lower and yields are a whole lot higher. We'll pick up on that story through the week as we wait for Eurozone CPI in a couple of days' time. Your bond yield on a 2-year right now, 4.82. That's the price action. Here's the trading diary. Coming up, consumer confidence, top of the hour. Chicago Fed President Goolsbee speaking at 2:30 Eastern Time. President Biden discussing healthcare at 3 p.m. ISM manufacturing and Tesla's Investor Day on Wednesday. And finally, President Biden meeting with German Chancellor Olaf Scholz at the White House to close out a week on Friday. Tomorrow, fantastic lineup for you. SocGen Subhadra Rajappa, Citi Stuart Kaiser, Morgan Stanley's Mike Wilson. We'll catch up with those three tomorrow morning. Looking forward to doing that with you. From New York City this morning, that does it for me. That rounds out my morning. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.